Hey everyone, so today I'm going to talk about something a little bit different, which is the FOMC. The FOMC, or Federal Open Market Committee, is a group within the Federal Reserve that just put out a statement. And I read it so you don't have to. Now I know Fed speak can be pretty complicated sometimes, and they say things that are pretty arcane or not clear, like things like accommodative monetary stance, right? Whatever that means. So in this video, I'm going to talk about what they said and what they're doing, why they're doing what they're doing, and what it means for investors like you and I. So what are they doing? Well, the Federal Reserve has goals over time to maximize employment as well as maintaining a 2% inflation rate. To do this, they decided to keep Fed funds rate, or basically the interest rate, at 0 to 25 basis points. Now, for those who don't know what basis points are, that just means that they're keeping the rates at around 0 to 0.25%. Of course, this was expected due to the recent impact in GDP, job markets, and the slow recovery in the economy, as well as the still low oil prices, which because oil is a factor in inflation. In their statement, they say they'll keep interest rates low until moderate levels of inflation have been reached, as well as maximum employment returning. They also say they'll continue buying treasuries as well as mortgage-backed securities to support market functions. This will help provide credit to businesses as well as households. Now, this may seem like the Fed is basically printing money for big banks and big businesses that you won't see, but actually, by providing this liquidity, they are able to reduce spreads on things like equities, bonds, deals like loans, and as well as reducing market volatility. So why are they doing this? Well, if you look at some indicators of economic activity, we're above the recent lows of the year, but for things like consumer demand, we're still quite low compared to the recent highs, and unemployment is still extremely high compared to the average. Consumer confidence is also pretty weak, especially in the recent months and the recent data, where consumer confidence hasn't really recovered yet. So why does a low interest rate matter? A low interest rate basically drives investment in the economy, and investment projects are valued higher. Companies are valued higher. Basically, businesses in a low interest rate economy are incentivized to spend their money in investments and projects that will generate cash, and these investments will lead to wealth generation as well as new jobs. So there's a part in the Fed statement that says they're aiming to achieve inflation moderately above 2% for some time. What I think that means is basically they're aiming to bring back inflation back above the long-term inflation rate of 2%. Now, because inflation might be below 2% for a long time, on a longer time frame, on average, they're going to appear to be below 2%. Now, as we can see here, since the 2008 recession, the Fed has some trouble in the past few years maintaining inflation above the 2% target. What I think they're signaling here is that they might hold interest rates low or near zero, even if inflation reaches 3% or more for a few quarters. But obviously the wording here they use is pretty obscure, and that's probably by design. They probably don't want to make promises that they can't keep. Basically, the Fed is signaling that there will be long-term low rates to drive inflation, and that those low rates will be around even when inflation comes back. Now, if you're an investor and you're holding bonds, you're going to end up getting a very low or even zero return. A lot of assets you're going to be holding, especially cash, will slowly or even quickly diminish in value. Basically, what I would increase in holdings would be things that are sort of inflationary hedges. And what I think are inflationary hedges are things that A, are scarce, and B, have value. Now, these are some of the assets which I think will be a good hold in an inflationary environment. 1. Physical precious metals. Basically physical gold and silver. Now, why physical is because you won't have to suffer from market volatility that might affect margin calls that might happen to you. Physical precious metals have been an inflationary hedge for a pretty long time, and they're pretty common just because that they're scarce and they have a pretty good value and they hold their value. 2. Fine art. So with fine art, the same logic follows. They're limited in quantity and they hold value. Now, of course, I'm not talking about the paintings you get at IKEA, but a couple of paintings that are around, a couple $1,000s or maybe more are probably a good idea to store cash or value in. Number 3, expensive/fine wines. Now, of course, I'm not talking about the box wines you get at the liquor store. These are the wines that you buy and hold and don't drink immediately. Like the previous inflationary hedges I talked about, each year, each harvest they get are pretty scarce. There's limited supply, and they generally hold the value, even increasing in value over time. And finally, I also think that relatively expensive watches would also be a good inflation hedge, especially those that are limited edition or in limited supply. I'm not talking about your Seikos or your Timex or those kind of brands, but more of like your Rolexes or your Omegas, watches at price ranges around at least a couple $1,000s. Now, hopefully this helps you understand what the Federal Reserve really means in their statements, and as always, stay safe out there.